$150 billion. I really just want you to let that staggering number sink in for a second. In the high-stakes world of global energy and chemicals, building a portfolio of that magnitude usually takes decades, literally generations of work. But what if I told you a single investment vehicle reached that scale in under 2 years? The sheer velocity and the immense scale of this capital deployment are quite frankly rewriting the rules of the global market right before our eyes.
Welcome, B2B energy leaders, to this precise, evidence-led explainer. Today, we're bringing you a strategic briefing straight from Project 54, Revenue Architecture Engineered. We're going to lift the hood on XRG. That's the massive international investment arm of the Abu Dhabi National Oil Company, better known as ADNOC. If you sell to, compete with, or even just track the Gulf majors, understanding this specific vehicle is no longer just optional. It's an absolute commercial necessity.
So, to make sure you get exactly the actionable insights you need, we've broken today's briefing down into 4 quick parts. We'll start by explaining exactly what the XRG vehicle is. Then we'll map out its 3 core platforms and the megatrends driving them. After that, we'll dive into the major acquisitions and deal flow. And finally, we'll unpack the commercial reality of what all this actually means for you.
All right, let's jump right into part 1, the XRG vehicle explained.
Okay, so what actually is XRG? Well, get this. When this entity launched back in November of 2024, it was an $80 billion platform. Fast forward to today, less than 2 years later, and it has exploded into a vehicle valued at over $150 billion. I mean, that kind of hyper-aggressive growth absolutely demands a closer look, right? By definition, XRG is the international investment company launched by ADNOC to essentially take Abu Dhabi's energy capital global. But here is the really critical distinction you need to remember. XRG was not created to just sit back and passively hold financial stakes. No, it was explicitly designed to build active, international operating businesses across natural gas, chemicals, and lower carbon energy.
And honestly, this setup brilliantly illustrates the organizational genius behind the whole thing. Think about a traditional national oil company for a second. They carry heavy baggage, political pressure, regulatory red tape, strict balance sheet constraints. It can be slow. But by structuring XRG as an independent investment company, sure, it's wholly owned by ADNOC, but it has its own dedicated board and a custom multi-year mandate, they achieved this total structural masterstroke. They completely separated XRG from ADNOC's core domestic production. That freed this new vehicle up to go after acquisitions and joint ventures with the exact same speed and risk appetite of a top-tier global investor.
Which brings us to Section 2. Let's look at their 3 platforms and the megatrends behind them. Notice how cleanly XRG maps its 3 core investment platforms directly to undeniable global megatrends. First up is gas. They are aggressively building a world-scale international gas and LNG portfolio. And why? Because they specifically view gas as the crucial bridge fuel required to meet the absolutely explosive power demands of artificial intelligence data centers and heavy industry. Second is chemicals. Driven by the rapid growth of emerging economies, XRG has put a stake in the ground with a stated ambition to become a top 5 global player in polymers and specialty materials. And third is lower carbon. This focuses on the decarbonization technologies that are entirely necessary for the ongoing energy transition. You see, this matrix isn't just corporate jargon for a slide deck, it's the rock-solid underwriting thesis for every single dollar they deploy.
All right, moving right along to Section 3, let's look at the hard data, major acquisitions and deal flow.
We really need to talk about the unprecedented velocity and scale of XRG's deal flow here, because it is just wild. Over in chemicals, they moved incredibly fast. They completed a massive, roughly $17 billion takeover of the German polymer maker Covestro, locking down over 91% of shares. Then, they partnered 50-50 with OMV to form Borouge International. That is a jaw-dropping $60 billion polyolefins champion that folded in Borouge, Borealis, and famously absorbed Canada's Nova Chemicals, the whole shebang. Meanwhile, over in gas, they launched Archius Energy alongside BP, and they're actively targeting a deep pipeline of transactions across the American gas value chain. Like we said earlier, they aren't just buying paper, they are acquiring massive platforms that they can actively build on.
When you actually plot this out on a timeline, the speed is genuinely staggering. Look at this. XRG launched in November 2024 at $80 billion. By early 2026, the massive Covestro takeover and that Borouge International formation were already underway, with the board's transactions completing by the end of March 2026. But here's the kicker. Consider the explicitly stated goal from their board. They intend to more than double XRG's asset value over the next decade.
So this $150 billion footprint we're looking at today, that is not the endgame. It's literally just the starting line.
So, let's bring it all home with Section 4, the commercial reality.
I want to pose this bold question directly to you right now. Why does all of this actually matter commercially? Well, if you are a procurement strategist, a deal maker, or a supplier operating in the B2B energy space, understanding XRG is flat out a survival metric. This isn't just fun market trivia to impress your colleagues at a networking event. Your core commercial strategy depends entirely on comprehending the massive shift we're about to look at.
Think about the current reality of the market right now. For the most part, Western energy majors are taking a highly defensive posture. They're retrenching, they're defending their balance sheets, cutting buybacks, and in a lot of cases, selling off assets. Meanwhile, XRG is acting as a massive counter-cyclical buyer. They are deploying exceptionally deep capital and actively building out global operating platforms. So, when the West pulls back, XRG is stepping right in, which makes them a rare and incredibly active source of deal flow and capital in today's environment.
So the bottom line is this. If you sell into the energy or chemicals value chain right now, XRG and its portfolio companies represent a rapidly growing share of your addressable market. But with that kind of scale comes concentration. You're dealing with a single, incredibly fast-moving, state-backed investor that is reshaping European chemicals and American gas simultaneously. This heavily concentrates competition, governance, and your overall exposure risk. You simply cannot build a resilient revenue architecture today without planning around XRG's massive and growing market share. I'll leave you with this sharp, provocative thesis straight from the research team at Project 54. The buyer is changing, the capital is moving east. XRG is absolutely the ultimate proof of that shift. For leaders in the B2B energy sector, the mandate couldn't be clearer. You either map this strategic shift early, or you are going to get left behind. So the real question is, how is your organization preparing for this entirely new center of gravity? Thank you so much for joining me for this explainer, and I highly encourage you to take this intelligence right back to your teams today.